This podcast is for financial professional use only and is not intended for use with the public. Material is for informational purposes only and is not intended to provide tax, legal, or investment advice. The opinions expressed in this podcast are those of the participants and do not necessarily reflect the views of Ash Brokerage. Welcome to Accumulation to Activation, the podcast that breathes life into your retirement planning strategies. If you're an advisor aiming to elevate your practice, deepen client relationships, and stay ahead of retirement income trends, we'll help you capture the opportunities on your doorstep and increase your impact. Each episode, we'll unpack the forces reshaping our industry, from the $44 trillion generational wealth transfer and the evolution of income planning to behavioral shifts, legislative updates, and breakthrough solutions that redefine financial security. Here are your hosts, Mike McLaughlin and Tim Ash.
Hello, everybody, and welcome back to Accumulation to Activation, where we talk about all things from accumulating your nest egg to making sure that you activate it and have your best possible outcome when it comes to retirement income planning, as well as all the other risks around retirement income planning. I am joined by Tim Ash, as always. How are you today, Tim?
I couldn't be better, McG. Just excited to be here. And I know we have a great episode coming up. Want to say thank you to the advisors and friends that tune in to this. We appreciate it. And again, these are our opinions, so feel free to give us any feedback that you would like. And what you will hear back from us is just our passion about trying to help people retire and live a better life. So thank you.
Yeah, absolutely. And to tag on to Tim's comments, obviously feedback, but also if there are any questions or topics that you want us to talk about on an episode, please submit those and we will make sure that we get that on an upcoming episode. But for today, Tim, I wanted to round out the last couple series that we've done relative to the Fisher Investment Annuity Insight reports. We've talked in previous sessions and episodes that some of the information isn't necessarily false, but there is some omitted information and some things that just aren't clear. And one of the things I want to spend some time on today is the robust discussion that the Annuity Insights report had about liquidity. Obviously, annuities are long-term investments intended for retirement planning. They do have surrender charges because there are no upfront sales charges and things like that. But there's a bigger issue around liquidity when it comes to portfolio. And talk about how annuities can actually create more liquidity inside of a portfolio.
Well, I'd be happy to. And again, I do appreciate the marketing and the insights that Fisher Investments puts out there. However, the omissions are just something that I cannot overlook and we cannot, nor can the industry overlook. So let's talk about that. Let's talk about liquidity. First of all, annuity contracts, if someone passes away, it's 100% liquid. There are no market value adjustments. There are no surrender charges. Now, I'm talking in probably 98% of all annuities. Are there some annuities that have those charges and penalties at death? Yes, but these are not the ones that we're talking about. And this goes back to us saying annuities aren't bad, but there are bad annuities. So I want to tie it into that. But I think of things like long-term care. And there are annuity products that have liquidity and freedom from market value adjustments or surrender charges in the event. So death is one event. Long-term care is an event. Two of six ADLs, which is part of that long-term care conversation. And I look at that, and here's the biggest one to me, the free withdrawal provision. Hey, Mike, can you tell me which bonds out there have a free withdrawal provision of up to 10%?
Zero.
None. So when I think of liquidity, I'm actually saying the annuity is actually more liquid than, I could argue, than a bond. So what's your take on it?
Yeah, I completely agree with you on that because as we're recording this, there is conflict in the world, and there's conflict in the world every day, but there's a larger conflict creating volatility. And I've always argued that, especially when you take a look at times of COVID, at times of the financial crisis, 9/11, all kinds of those black swan events, I would make an argument that your portfolio is not liquid when the market goes down 20%, 30%, or 40%. And this is where the stability of an annuity, specifically a fixed and a fixed indexed annuity, can provide some much needed liquidity. Also, I want to go back to some previous episodes where we talk about cash on the sideline. Today in America, there is $27 trillion sitting on the sidelines for advisors to get money in motion right now. And most of that is in certificate of deposits, which are 1 years, 3 years, 5 years. And you're giving up all of your interest in if you have an early redemption penalty and maybe even getting into the principal. And so having the liquidity of 10% free withdrawal, of long-term care, death proceeds. The other one that we need to be thinking about also is RMD, because as you age, that RMD percentage goes up above 10%, and most carriers will allow a greater than 10% for a required minimum distribution coming out. There's a lot more liquidity inside of an annuity than most people think. But today, let's talk about the results of our annuity performance review, because we are creating liquidity with the use of an annuity for more portfolio. So talk a little bit about that, Tim, about how we're increasing income, but more importantly, increasing liquidity inside of the portfolio.
Certainly. Well, the pricing today on products that have income riders or are an income product in and of themselves, like a SPIA or a DIA. So I don't like using acronyms: single premium immediate annuities, deferred income annuities, and then the fixed indexed annuities that have the lifetime income benefits. We're actually freeing up assets that are normally held hostage in a traditional stock and bond asset allocation. So, what we're able to do by allocating money to something that's going to provide that predictable income month after month after month, no matter if you live to be 105, you take that off the table and you free up assets that can be put into the portfolio. And that's a great inflation hedge. It's also great for your business model if you're an asset manager, because if you have assets that are growing and you charge based on the assets you have, that's a great way for you to not only help your client, but help yourself. And I think that's something that is missed. Uh, there's just too much rhetoric out there around, annuities are not the best thing. And I don't understand it. I really do not. When I see all of the advantages, I've also never heard anyone return a social security check saying, I don't need this or I don't want this. Annuity income's the same thing. That baby is just going to pay a monthly check as long as you live, and tie it to a spouse. And the interest rate environment that we are in, with the 10-year treasury north of 4, really is favorable for pricing on these products for insurance companies. So we have all of these positives and momentum that are in our favor, and all you have to do is just utilize them. And we're not saying throw away the allocations that you've done before. We're just saying enhance the allocation to incorporate these strategies that can free up assets to do other things later in life.
I love the line that nobody has given back a social security check. That is an absolute true statement, I'm sure. And I don't even have to fact check that, but You're exactly right. No one gives that back. No one's given back a death benefit when they've delivered it. So great. That's a great line that I wrote down. Um, you talked a little bit about market value adjustment. Market value adjustment can obviously work for you and against you, but we're in an environment where even though the 10-year Treasury is above 4%, speculation is that it will go down. New Fed chair coming in probably will lower interest rates. We have a huge national debt. Not sure that we can sustain a 10-year Treasury and may have to reduce interest. That becomes a positive market value adjustment and just another reason to do some reviews. But talk a little bit about the power of market value adjustment, the gain that you pick up, but most importantly, the need to review all of those contracts.
Well, the omission that we talked about in the report is that it's implied that a market value adjustment is always a bad thing. Now, I'm going to look over both shoulders here. Every bond that's owned has a market value adjustment. So saying a market value adjustment is bad on an annuity and not also saying in the same sentence that bonds carry market value adjustments makes no sense to me. It's actually not a fair characterization. Now, with that said, to your point, annuities that have market value adjustments in them, just like bonds, when interest rates go down, what happens to the value? It goes up. So a market value adjustment is not a bad thing. It's just a thing. And you have to educate your clients, just as you do with bonds. You do the same thing with annuities. If rates are rising, what happens? Down. If rates are lowering, the value of the asset goes up. It's a very simple thing. But what I don't like is fear mongering. I don't think it's right to say, oh, an annuity has a market value adjustment, and then you don't say the same thing with the product and or investment solution that you're offering in the portfolio. Just it's just not fair, in my opinion.
Yeah. And that's the purpose of this discussion, is to educate. And that's one thing that you've always challenged us to be a technology company or be an education company that happens to distribute financial products. And so that's what we've always tried to do, is educate. And I think it is important to be fair and balanced on the market value adjustment, but also just, the liquidity in total. I always look at outcomes over transactions. If you want to look at a transaction, then yes, an annuity does have a surrender charge, but placing an annuity inside of a portfolio can actually create a lot of liquidity and take pressure off the assets under management to redeem at an inappropriate time. And to put numbers to your previous example of creating capital, our average annuity performance review still remains at 39% increase in income. Many people don't need that income right now. And so we keep it at the same level. And we have the ability to protect two people, going from a single rider to a joint rider, and then still creating, 30% more capital that can go to long-term care, can go to healthcare, can go to assets under management if the business model is appropriate, which then can help offset inflation, which is probably the cruelest tax of all. Speaking of taking some risk off the table, one of the biggest risks is longevity and retirement income planning. You have a great acronym for QLAC, and that can actually take the long tail off of your portfolio risk. So, talk about the acronym and the use of QLAC.
Yeah. So before I do, I'm sorry, I got off on a tangent with market value adjustments, and you asked me about the annuity performance review, which you so eloquently explained. We're improving outcomes for people. That's what this is about. Outcomes matter more than returns matter. We'll talk about that probably in another episode. But QLAC, so I I love acronyms. I call it quit losing assets consistently. And what that means is that you have the ability. So when the United States government puts something in the tax bill or a tax code, what do most people do? They maximize it. Don't you maximize your 401k? You advise your clients to maximize their Roth IRAs and IRA contributions and profit sharing interests and all the things that are out there. But yet, we have so few people that are taking full advantage of the QLAC, which is the ability to defer required minimum distributions. And Mike, you can share the dollar amounts because I will certainly get them incorrect. What are they? How much can a couple defer now into a QLAC, which doesn't have to turn on until as late as age 85? Our recommendation is to elect age 80 because you have a 5-year window on either side of that age.
Correct. Yeah, it's 211,000 for every individual, so 422. So a lot of dollars that can be deferred and take that long tail off the table.
Yeah, and how many times do we hear, "I don't need the RMD. I don't want the RMD." But if you don't take it, then it's confiscated at a rate of 50%. So this is a great way for those clients that are saying to you, I really don't need the income off of this large qualified plan asset that I have. Is there a way that we can at least defer a portion? The answer is yes. And, for folks that have significant balances in their qualified plan accounts, this is a great way to put, if they're a married couple, $422,000 and defer it out. And that long tail that you talk about, McGee, is they live to 95 or they live to 100, the payout rate that you see on these QLACs is off the charts in a good way, because it's mortality based. So if someone turns on income at 85, the table is saying, well, you're 85, so the payout rate is going to be very high. So it's a great way to have a conversation with your clients about solving something that might be bothering them. That is, I don't need to take it. However, on the tail end of it, they'll be happy they have it because of the mortality-based payout.
I think it also changes the conversation about how do we manage the assets? Because if I've got to manage $1 million for the rest of your lifetime, and I don't know how long you're going to live, I'm going to manage those assets maybe a little bit too conservative. Whereas if I can stop and put a bumper at age 80 or 85, I know exactly how I can manage this, and I can manage it for a 20-year set period and then have a backstop there. So it gives the financial planner a lot of options when it comes to managing money, taking maybe a little bit more risk, especially in a down market, to shift to more equities than what you would maybe be comfortable with if you have to have this bucket of money. So one of the most underutilized tools, and I realize that a lot of people don't want to annuitize a certain part of their portfolio. That's where the use of a fixed indexed annuity comes into play. I would encourage everybody to reach out to their retirement income consultant. We've done a study using a QLAC every year since 2014. There are 48 cells in that study. We improved the probability of success in 46 out of the 48 cells. The only time that we did not is when we're placing a QLAC at age 55 and at the most aggressive equity position, which would make sense given the amount of equities and their returns over the last 20 years, which may not be repeatable. Anyway, so hey, we're running up on time. We always want to be respectful of our listeners' time. Again, we just want to kick around some ideas, make people think about annuities in a completely different way, and provide factual information about how to properly use outcomes or annuities to increase outcomes. So, Tim, thank you very much. Thank you all for listening. And again, I encourage you to like and on whatever your favorite platform is. And if there's anything you want us to talk about, make sure that you send us a message. We'll be more than happy to bat that around. Any closing statements, Tim?
No, really, thank you to the advisors. Thanks to you for enabling this podcast to happen. Without you, it doesn't. And I just want to say also, on the link that you get, share it with other advisors in your firm and or people that you think will benefit from this education. And if nothing else, please provide us that feedback. We want to hear more. And if there's something that we have said that you don't agree with, that's fine. We love to have conversation, and I don't even call it a debate. It's really when people are challenging something, it's because they care. And that's what I want to say about us at ASH is that we care and we want to provide this type of education to you, to your advisors, to your practice to make life better for others. So thank you.
This episode of Accumulation to Activation was produced by Ash Brokerage. For more on the most pressing and critical issues facing financial advisors today, be sure to subscribe, leave a review, and share this episode with a colleague. For more resources, visit us at ashbrokerage.com or reach out to our team at 800-589-3000. Let's start a strategic conversation about how you can be more efficient with your retirement income and legacy planning solutions. Insurance product guarantees are subject to the claims-paying ability of the issuing insurer. Annuities are insurance contracts and may be subject to fees, surrender charges, caps, spreads, participation rates, and tax implications. Withdrawals are taxable and, if taken prior to age 59 and a half, may be subject to an additional tax. Product availability and features vary by state and carrier. Social Security and tax rules are complex and subject to change. Clients should consult their tax and Social Security advisors. Any modeling or Monte Carlo analysis referenced is based on stated assumptions and are illustrative only. Results vary by client profile, market conditions, and product selection. Past or modeled results are not guarantees of future outcomes.